No change in the Fed's bond buying program. Continues at that $85 billion a month pace. 40 in MBS, 45 in Treasuries. Again, that stays the same. Much of this statement remains the same as well. There are some modest changes to the language on the economy, but basically this is almost a replay of what we saw back in September. Let me read you from the key section of the statement, identical again to what we saw in September. Taking into account the extent of federal fiscal retrenchment over the past year, the committee sees the improvement in economic activity and labor market conditions since it began its asset purchase program as consistent with growing underlying strength in the broader economy. However, the committee decided to await more evidence that progress will be sustained before adjusting the pace of its purchases. Again, the key part of the statement. Let me talk through a little bit of the changes in the economic language here. Economic activity has continued to expand at a moderate pace. Indicators of labor market conditions have shown some further improvement, but the unemployment rate remains elevated. Available data suggests that household spending, business fixed investment advanced while the recovery in the housing sector slowed somewhat in recent months. Fiscal policy is restraining economic growth, and apart from fluctuations due to changes in energy prices, inflation has been running below the committee's longer-run objective, but longer-term inflation expectations have remained stable. The Fed did remove language in here referring to tightening financial conditions. That's gone from the statement, but the forward guidance remains the same with regard to what's going to happen to interest rates over time. Again, repeating here what the Fed has said in the past, the committee decided to keep the target rate for the federal funds rate at 0 to 0.25% and currently anticipates that this exceptionally low range for the federal funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%. Inflation between 1 and 2 years ahead is projected to be no more than half a percentage point above the committee's 2% longer-run goal, and longer-term inflation expectations continue to be well anchored. Finally, the vote was not unanimous. We had one dissent again. Esther George once again remains concerned the continued high level of monetary accommodation increased the risk of future economic and financial imbalances, and over time could cause an increase in long-term inflation expectations. So basically a replay from the Fed from the September statement. No change in the bond buying program. No indication of when tapering could occur.